Hannah Kessler.
This gal started her own bank at the age of 18, and then you became a self-made millionaire by the age of 24?
I did.
Hannah Kessler is a money mentor.
She's known as the single millionaire chick.
With advice on how to stop living paycheck to paycheck.
Money starts with your mindset.
How you think about your money is going to greatly impact how much money that you have.
I grew up in a town called Olathe, Kansas. I'd be walking out of the door, going to school, and my mama would holler at me, "Hannah, make good choices." And I'd have to holler back, "Because the choices I make today will affect my future."
My parents, they did a very good job about teaching me as a child how to handle my money. We have a lack of understanding when it comes to money.
If you want your kids to have money, you need to start talking to them about it while they're young.
I'm really second generation to this concept that's called the infinite banking concept.
And at 18 years old, my dad gave me the choice to start my own bank that then led me to becoming a millionaire by the time I was 24.
Now you've written a book to help tie it all together.
So the companion is really just teaching kids that, not specifically money, but really important life lessons.
Now being the owner of the Money Multiplier, I help serve over 17,000 clients in every state of the country.
Where can people get the book?
HannahKessler.com. Hannah spelled the same way forwards and backwards, Kessler with one S.
Also, I got my podcast show, the Money Multiplier Podcast.
And make good choices today, because the choices you make today will affect your future. Good morning, my friends. Hey, y'all, sorry I'm a little tardy on you. I know we're starting here at 9:14, 14 minutes past the hour. I had to go to the gym today because I had to go and blow off some steam. All right, and then I had a shower. Because, all right, this episode, okay, I'm coming with some energy, y'all. I'm coming with some tough love today. So, hello, good morning. We have some things we need to talk about, all right? There's some topics I need to get off my chest, okay, with just the conversations that I've been having this week with some of my clients and people who are interested about the infinite banking concept. And I want to go through some foundational concepts and knowledge that we need to have in order to implement this concept and this process for ourselves. Now, this kind of comes from even my father. Dad, sometimes I'll have to get on him because I'm like, "Dad, you're being a little too aggressive right now." And he goes, "Well, Hannah, I'm sorry, but I'm not here to be your friend. I'm here to be effective in your financial life. I don't expect you to invite me to your Christmas gatherings, your Thanksgiving dinners, or your birthday parties. It's okay. I got plenty of friends. I'm not looking for new friends, but I'm here to be effective in your financial life. Because if I'm not going to be here to do it, who else is going to be here to do it for you?" You see what I'm saying? So I'm going to be coming to y'all with a little bit of tough love here today, okay? So hopefully just take that with a grain of salt, all right? But I think this is a conversation that we need to have. Before we get into it, good morning, my beautiful friends. Dexter, I see you. He says, hello, hi everyone. Hello, Miss Hannah, spelled the same ways forwards and backwards. I've been saying that a lot. When I give my email away, Hannah@themoneymultiplier.com, I say it's Hannah, spelled the same ways forwards and backwards, @themoneymultiplier.com. So good to see you, Dexter. Hello, Mr. Dave. Devon, good to see you, my man. Annette, good morning. Oh, yes, and good reminder. Thanks, Annette. Yeah, hit the like button. As a reminder, I'm here every Thursday, 9 a.m. Eastern time, where we go live for Money Mornings with Hannah. And if you cannot catch this live, you can always go and watch the replays posted up on YouTube or even on all of your podcasting platforms, Money Mornings with Hannah. So Misty, good to see you as well. And CLG McCoy, good to see you, my man. I think it's the first time I'm seeing you on here. All right, y'all. So here's kind of the topics I want to get into. This episode is more for my infinite banking vets, if you will. We're going to get into how do we read our policy illustrations, okay, and how this whole concept started, or this topic, I should say. I was texting with one of our insurance company reps. He's the vice president at one of the mutually owned insurance companies. And he actually worked alongside Nelson Nash for a long time. And I was like, person, we're going to call him M. I just don't get it. Why do people feel that they need to see policy illustrations in order for them to understand this concept? I mean, this is one thing that Nelson actually said. He says, the one thing I regret ever doing is putting policy illustrations in this black book, Becoming Your Own Banker, because people get so hung up in the numbers. Y'all, it's not about the product. It's about the process. How am I utilizing this policy to finance the things that I'm already going to go buy in life? Okay, because back a little bit ago, we went through our T charts. Okay, do you guys kind of remember our T charts where I said, hey, take out a pen and paper, and we're going to explain the differences between commercial banks and mutually owned life insurance companies. And why do we keep the money stored within inside of our policies and not in other vehicles that we do have access to? Okay, so the big vehicles that we have access to, where do I keep my money? Okay, because let's just even back it up a little bit. Well, I have to make money to live here on this earth or on this planet or on this country called America. Okay, that's how I pay my bills. That's how I feed myself. That's how I keep a roof over my head. That's how I pay for the college tuition. That's how I pay for my taxes. That's how I go on vacations, yada, 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 right? I have to go make money. And that's what Nelson always says. You want to be in two businesses in your lifetime. The first business is the one that you're passionate about, gets you up out of bed every single day, supports the livelihood, supports the family, okay? But then the second business is the banking business, the business that finances everything throughout your life. And that's what we're here talking about, is that banking business. So the first business, the one that supports our lifestyle, livelihood, our family, that's the business that y'all are in. You guys go make your money one of a few ways. You are a W-2 earner. You're a 1099 person. You're a business owner. You're an investor. Okay. You go and make some money some way, somehow. Now, when I go make that money, where do I go store the money? Conventionally, we've been taught that we go store the money inside of the local bank. Wells Fargo, Bank of America, US Bank, yada, yada, yada. Okay. That's one option. We could go leave it at the local bank. I could just keep the money in cash. I could have a big safe at my house. I could put it in my sock drawer. I remember when I was a waitress at Cracker Barrel back in my Kansas City days, and I'd get paid out my tip money in cash every single night. I would have a shoebox in my closet. I would keep my cash in there. And then every Friday I'd go down to the bank and I'd say, hey, banker, here's my money. Go deposit it into my account. Right. So I could keep it on hand on cash, but obviously, you know, I don't really want to do that because then I'm subject to flooding, fire. Okay. If you've ever read my father's book, Mapping Out the Millionaire Mystery, you know his story with his parents when they were living on the sailboat. They went to the grocery store one day and somebody left the stove on in the sailboat and the sailboat went up in flames. Well, what happened to all their money? Their money, their cash went up in flames with it. Also, if I keep my money in cash on hand, then I'm actually losing money due to the hidden tax we call inflation. Or I could go store my money inside of those qualified accounts like a 401k, an IRA. I could leave it in a brokerage account with my financial advisor who they're controlling my money. They're investing those dollars that I'm saving for myself. There's these different vehicles that we could leave our money in. And here's where I'm different. I'm never going to tell you how to go make your money, how to go invest your money. Sure, if you want to have those buddy conversations, I will turn you on to what I'm doing, what's working out for me over here. But I'm not a financial advisor. I'm an educator when it just comes to money, and I'm an infinite banking practitioner. I teach you about the banking business in your life. So to go all the way back to the first place of where we've just been conventionally taught to keep our money inside of the commercial bank. Well, why do I keep my money down at the bank? Well, I don't know, Hannah. That's just where they keep the money at. That's my parents opened me up a checking account when I was 13, 14 years old. And I had that student checking account when I got my first job and I started working, and then I put my money in there. I still remember when I went down in Olathe, Kansas to the Price Chopper. Okay, they have Price Choppers over there. That was the grocery store. And there's a U.S. bank inside of a Price Chopper. I went there with Mom and we sat down and I opened up my first ever bank account when I started working my first ever job at one of the chiropractic offices of Mom and Dad. And actually the chiropractic office was connected just around the corner in that same building to that Price Chopper. So it was just right there. So you had the offices and, there's a few other stores. There's like a nail salon, a hair salon. There's a liquor store there. And then you come around the corner, then you got Price Chopper, the main building over there. And then there was Starbucks inside of Price Chopper, and then also the U.S. Bank. And Mom helped me open up my first checking account for myself when I started to get paid at 14 years old. And that's what we're conventionally taught is, hey, I'm going to go keep my money down at the local bank because, well, that's just where they keep the money at. And when I go make those deposits into that bank, well, I'm earning some form of interest at the bank, right? I'm getting paid some form of compounding interest. I don't know about y'all, but I'm making less than 1% inside of my checking accounts right now. I do know there's some checking accounts or high yield savings accounts that are out there. You're getting 4% or so on those accounts. But when you go and put your money at the bank, first of all, that growth that we get, do you think it's taxable or is it tax-free? That's taxable growth. You are getting taxed on the growth inside of that checking account. And then when you go put the money at the checking account, do you think your money that you have, they're taking your dollar and they're putting it backhand, and there's a little black box in the back that says Hannah Kessler or Joe Smith, your name, and they're keeping your money inside of that black box, waiting until you come back and you retrieve it? No, they're not. Because what are banks doing? Banks are using your money and they're lending your money out to you or to other people, and they're making a good living doing it. I mean, go do this fun little exercise, if you will. I don't have a bill on me right now. I wish I did. But let's make believe I had a $20 bill on me. And that $20 bill, I decide to put my initials on it and I highlight it in yellow. And I take it down to the bank and I say, hey, Mr. Banker, here's my $20. Please go and deposit this money into my checking account. Okay, the money gets deposited. And then say you go back in a week, a day, even a few hours, and you want to request your $20 back. Do you think they're going to give you the same $20 that you highlighted and that you put your initials on? No, they're not, because banks are in the lending business. They're lending out your money to you or to other people, and they're making a good living doing it. So if you just start to get into the mindset of being a banker, you are now utilizing that money to finance the things for yourself, your family, your lifestyle. Once you start to get into the banking business, quoting R. Nelson Nash, it can make you very rich and very wealthy, but you got to get into the banking business. And that's just the failure that as a society, they just never taught us about money. They want us to be consumers at the bank because, hey, if we depositors aren't going down and leaving our money at the bank, then they got no customers. They got no business to be made, right? So they want our money because they want customers. They want consumers to continue to make those deposits at the bank. So when I'm keeping my money at the bank, we talked about, hey, yes, I earn an interest, but it is taxable. Yes, I do agree that it is liquid money. I could go there, go take the money out at any point in time. Now, given though, I have had some experiences. I talked about this not too long ago. I had to go down to the bank because I had to wire over some money to do a lending deal. And I was sitting there with the guy. He was helping me do all the paperwork and whatever to transfer the money over, send out the wire. And a guy walks into the bank and he wanted to request out $15,000 in cash. And the bank teller told him, hey, sir, I'm sorry, we just don't have this $15,000 right now. Come back in a few days and we'll have your money then. And man, I was sitting there and he just exploded inside of that Wells Fargo branch office. I mean, he was so irritated. He's like, what do you mean you don't have my money? This is my money. I'm coming to retrieve it. And I want my money because I got to go do some other stuff with this money right now. I need my cash, right? So this is the whole issue with the fractional reserve lending system. Okay, if you guys want to go nerd out on it, fractional reserve lending that we have here in America is that these banks legally are not required to have any money on their reserves. Okay, the Federal Reserve posted out that legally in March of 2020, banks have to have 0% held on their reserves, legal requirement, and they're lending out your money. They can now go and lend out $8, $9, $10 for every $1 that it has held back on its reserves. And right, they're playing that game. Well, I hope and I think that not everybody's going to come and do a run on the bank and request all of their money out at one given point in time. I mean, seriously, how well has that been working out for some of these big banks where the Fed had to go and bail y'all out because they didn't want uproar in the streets? And so what the Fed had to do was open up their back doors of their printing press and just start printing more money into our economy. And then, oh, we're just so curious why inflation is so high and cost of living is so high. Oh, I could go on this rant forever and ever, but that's not the topic we're here to talk about today. I just want to start to set the tone of why we're keeping our money held there, right? I mean, it's just what we've been conventionally taught. It's what our parents are doing, our bosses, our colleagues, our grandparents were taught to do with their money is keep it down at the local bank. So instead, what I'm going to do is I'm going to put my money inside of my private bank, my infinite banking policy, if you will, AKA my whole life insurance policy, whole life insurance. And y'all, today's the day we are going to get into a little bit of the topic of IULs, okay, for my IBC vets. We'll get into that later here today. But I'm utilizing a whole life insurance policy. And I only want to use whole life when I'm implementing this concept. Could I do it with an IUL? Sure. But should you do it? Probably not. Okay. I don't have a good analogy, but it's that term of could you do it? Yeah. But should you? Probably not. Right. And again, we'll get into that deeper here in a little bit later on in this episode. But I'm utilizing a whole life policy, and I'm utilizing this with a mutually owned insurance company. And the policy, when you're doing this correctly for the infinite banking concept, the policy is being designed with high immediate cash value. How do we do this? Let me share my screen. Here's a little screenshot from a recent presentation that I did not too long ago. how the policy is set up and designed, okay? There's two moving parts inside of this policy. You have what's called your base premium, and then you have what's called the paid up additions. I'm not going to get so deep into this here today about the makeup. You can go and watch the past episode where we talked about the common FAQs that I get on the infinite banking concept, and I talk about the makeup of the policy. But how we're able to have this high immediate cash value is there's a paid up additions rider that's on the policy. Paid up additions, we call it PUA for short. Paid up additions. The majority of your premium is going into that paid up additions rider. And thus, by doing so, it's adding on more death benefit, which thus is giving us immediate access to the equity or cash value in this policy. So because of those paid up additions, that's how and why we have cash value made available to us immediately that we can pull out and start using from this policy. So the paid up additions is just a one-off, okay? It's not a requirement that you have to pay paid up additions inside of your policy to keep the policy alive and active. You should, because when you pay those paid up additions premium, that just means more death benefit, which thus just means more cash value that gets made available to you immediately. And my definition of immediately is within 30 days. So I always explain it in this rocket ship analogy. You know, the base premium is the base of that rocket. Your paid up additions are the booster rockets. Sorry, text going off. The paid up additions are those booster rockets that are being added on to the policy. And that's how and why the rocket ship gets out of the sky and out of the atmosphere. And that's how and why we have cash value made available to us year one, month one inside of that policy. So that's number one. I mean, if you're not going through the money multiplier to obtain your IBC policy, you just want to make sure that there is a paid up addition premium and paid up addition riders that are attached onto that policy. So let's even give you like a real example. This is a screenshot, okay? So from somebody's policy here. This is a makeup of a policy, okay? Now, actually, before I share this screen, let me share this one with you. This is the policy illustration, okay? Just starting on the very left-hand side. You have year, policy year 1 to 5, year 6 to 10, 11 to 15, so on and so forth, just a year of the policy. Then you have the age of that individual. Let me point out this little nugget. Oh, look, the age of that person, they're 67 years old. Hannah, 67 is too old for me to start a policy. I could never get approved at 67 years old. Yeah, no. You're thinking about this all wrong, okay? Age has nothing to do with the cash accumulation in your policy. It has everything to do with the death benefit. And that's why we're not meeting here today to talk about death benefit. We're here talking about the cash and the cash value that's inside the policy. The death benefit's going to be on this policy, whether you like it or not. Okay, so go watch another episode I did not too long ago about I'm too old to do this. My premiums are going to be way too expensive at my age. No, I debunked that. Go watch that episode. Man, I'm coming in hot today. Sorry, y'all. Welcome to class. Taking a sip of my coffee. Okay. So then you have contract premium. This is what I wanted to point out. Do you see how it says $20,000 a year underneath that contract premium? Removing this from stage, we're bringing our next screenshot up. How that $20,000 is brought up. You have your base policy or base premium, and you can see that there's $5,000 that's allocated to the base premium. Then you have the paid up additions. Do you see where that $15,000 is at? And it says blend accelerated paid up additions rider, $15,000 going to there. So when you add the 5 plus the 15, that comes together and makes the total of $20,000 a year premium that's going inside of this policy. That's how the total $20,000 is being made. Does that make sense? So that's how we're getting our total of the 20. We have 5,000 go into the base, 15,000 go into the paid up additions, comes together, makes our full 20. For my IBC vets, this is what's called a 25-75 split policy design. 25% of the premium go into the base, 75% go into the paid up additions. Now, another thing I want to point out to y'all, let's just talk quickly about the initial annual 7-pay premium. Bottom right-hand corner down there. Do you see where it says $24,549.78? What this is referring to, initial 7-pay premium, this is fancy terminology for what's called your modified endowment contract, your MEC limit, MEC, modified endowment contract. What the MEC is, it's an IRS tax law. We've learned about this a lot if you've especially been tuning into my content. The MEC in this policy is at $24,549. So what this means to me is that in this first year, my MEC line is at $24,500. I've already put in $20,000 of premium inside of this policy this year. So the difference between that $24,500 minus the $20,000 that I already put in, that $4,549, that's the additional money that I can put inside of this policy in this first year and not hit my MEC limit and not cause any tax consequences inside of this policy. Oh, because I failed to mention on this episode, your policy cash value grows tax-free. All of the growth in this policy is tax-free and the government is completely out of my hair. My bank account is taxable growth. My policy is tax-free growth. So when I get to that point that I'm taking out more from this policy than what I put into it, all of that growth is tax-free to me. See what I'm saying? So just to point that out, that's where we find the MEC limits for the first year. Now, given MEC is a moving target, okay? Let me go back full screen. MEC is a moving target. It's always going to continue to go up. We know where it's at year one, month one, but any time that you pay more in premium to your policy, anytime that you change the mode of how you're paying your premium, because you can pay premium monthly, quarterly, twice a year, or annually, anytime you change the mode of premium or you pay additional PUA premium, paid up additions into that policy, the MEC limit's going to go up. It's going to change. So that's why I always say, I know where this MEC limit's at year one, month one. But then as we go on with our life and we're using this policy and we are being an honest banker, I'm taking out my cash values, buying XYZ, then I'm paying myself back and I'm charging myself that interest. That extra interest, all it means is just extra paid up addition premium that I'm paying inside of this policy. So that's moving me, and I'm going to show you that example here in just a second, but that's moving me closer to my MEC limits. So I know where my MEC limits are at because it tells me right here, year one, month one. You may be thinking to yourself, but Hannah, what if I'm in year 5 of my policy? How do I figure out where my MEC limits are at? Well, if you're a money multiplier member, reach out to your mapping specialist, reach out to your implementation agent. They'll help you find it, or write in directly to the insurance company. Send an email to policy servicing and say, hey, how much extra can I fit inside of my policy this year without hitting my MEC limits? And then that email will go to the actuary department. They'll go run their calculations and do all their nerdy work over there. And they'll report back to you of how much extra that you can fit inside of that policy right now at this given point in time. Okay, because like I said, it's a moving target. It's going to keep going up each and every year. So let me bring back up this illustration here. Let's remove that. There we go. So that you can see the full screen there. Here, actually, let me even take off. Can I do this? Yeah, I think you guys can still hear me. Good. All right, you can't see me, but you can still hear me. I just want to make this full screen for y'all. In this policy, here is how I read the policy illustration. Notice that there's a guaranteed side on the left and there's a non-guaranteed side on the right. On the left-hand side, guaranteed. This is what I call the worst thing the policy can ever do. This is that contractual guaranteed interest that the insurance company has to pay us each and every year. So guaranteed side is the worst thing my policy can ever do. The difference between guaranteed and non-guaranteed is the projected dividend. I can't sit here and promise y'all dividends inside of your policy every year because dividends are not contractually guaranteed. However, with the 6 companies that I personally do business with, these dividends, they've been paying them out for over 125 plus consecutive years. Some insurance companies, they've been paying them out for over 140 consecutive years. So is there a pretty strong chance that these insurance companies will keep paying out their dividends? Most likely, okay? And honestly, bring myself back to screen for a second. This is why I actually started my podcast show, the Money Multiplier Podcast, because it gets very interesting. When you start to peel back the onion and you understand why these insurance companies have been paying out these dividends over this long haul consecutively, it gets really interesting because they're not operating on that fractional reserve lending like conventional banks are. They're operating off of the school of thought of Austrian economics. And so what that means is essentially they're responsible with their money. They're treating their dollar with respect. And when you treat your money with respect, it's going to flow and grow to where it's respected to. So these insurance companies are not lending out more money than what they have on hand. $1 in their reserves has to protect the $1 that insurance company has invested out elsewhere in bonds, in real estate, in policy loans, etc. Okay? So with these insurance companies, think about it. They've been paying out dividends during the times of 2008, the Civil War era, the Great Depression. How are these insurance companies still paying out a surplus and dividends to all their policyholders when everything else was up in dumpster fire flames? You see, do you kind of see why I feel safer keeping my wealth with these insurance companies compared to conventional banks? Bring it back full screen here. Guaranteed side. How do I configure my cash values? Now, this policy illustration is just a little bit different. You notice how there's a cash value and then there's also a PUA cash value column. I actually love how this insurance company illustrates this out because literally what it's telling you is the cash value, that's that regular cash value column. That's the cash value that's coming from your base premium only. PUA is the cash value that's coming from the cash from the paid up additions, your paid up addition riders. So this is what I'm referring to and why you can see that it's so important that we add on these paid up addition premiums to this policy, because if we didn't add these on, we would have $0 of cash in the first year. It starts to build up, okay? Cash value in a whole life contract has always built up, but we're just accelerating it by capitalizing into that paid up additions to allow us to have cash value immediately to us. So if I'm trying to configure my cash value on my guaranteed side, I'm going to add 0 plus the 14,474. So it's telling me year one cash value is 14,474. Year two, I would add the 919 plus the 29,327. That would be my total net cash value in year two on the guaranteed side. And then just go down the columns. You can read it, take a screenshot of this. This is going to be posted up as a replay. You can study this illustration if you really, really want. But that's how I configure my cash values on the guaranteed side. Now, when I'm reading these illustrations, I always look at the guaranteed side for year one, month one values. Once I start to get into year two, that's when I start to flip over to the non-guaranteed side. Underneath the non-guaranteed side, it's the fourth column from the right. It says total net cash value. And the reason that I look over here at my total net cash value is, like I said, I can't promise you dividends inside of your policy, but with the lowest insurance company paying out dividends for 125 consecutive years, is there a pretty strong chance that they're going to keep paying these dividends? The answer is yes. So year two and so on, that's when I start to look at the non-guaranteed side, total net cash value. And then you can see year by year how the cash value is performing with the projected dividends. But like I said, you can always refer back to the guaranteed side. Now, honestly, since implementing this concept in my family since 2008, these illustrations are pretty spot on. Okay. Yeah. Could they be greater some years, lesser some years? Absolutely. But is it by a whole lot that it's off? Not really, because they've been in business since the late 1800s, early 1900s. These insurance companies and these actuaries kind of know what they're doing. You see what I'm saying? So they're not overinflating the non-guaranteed side. Now, how do I bring myself back? There we go. Now, given IUL illustrations, they will overinflate the non-guaranteed side, and we'll talk about that. But with this policy illustration, know that they're not, because it's a whole life company. Now, here's something else too. My opinion, I think it should be a fact, but here's just my opinion. If you're going around and you're shopping with insurance companies, let's even talk about that before I go into shopping with insurance companies, comparing illustrations. I wouldn't go on this whole adventure by yourself. Work with an infinite banking practitioner, okay? Even if it's not me, it's not my father, it's not Chris Noggle on my team or another money mentor on my team. That don't matter to me. I just want y'all to really get this stuff, and I want y'all to truly understand how money works and this banking concept in your life actually works. But if you are going around and shopping, if you will, go with an infinite banking concepts practitioner. Don't just try to go out here all by yourself and pulling illustrations from insurance companies directly, okay? Work with somebody who's going to be that mentor. Here's how I put it, to use an analogy. If you have heart trouble, are you just going to go to the general practitioner, that doctor at your local hospital, to service issues that's going on with your heart? Or are you going to go to the specialist who's the cardiologist in that space? You're probably going to go to the cardiologist because that's what they specialize in. It's the same thing over here. This is specialized, specially engineered whole life insurance. And I can't tell you how many people call me up and they're like, Hannah, I got one of these policies, but I just don't know how to use it. Or my agent who set it up, they designed it incorrectly after watching your content, and I need some help here. Okay, so don't try to figure this all out on your own. Okay, go and work with an expert within that realm. So that's my big PSA. But my second big PSA is that if you are going to compare insurance companies, always compare the guaranteed side. Okay, people I got to use my words lightly, but sometimes insurance companies, they can put what they want essentially on the non-guaranteed side. I mean, yeah, it's got to be within compliance, and they got to make sure they're illustrating this out correctly and not misleading the public. There's very strong compliance laws that they have to follow. But when you're comparing company to company, always, always, always just compare the guaranteed side to it. Okay, that's my big PSA. Now to bring back up the illustration page. On the non-guaranteed side, total net cash value, here's what I look at. There's 2 break-even points that I look at inside of this policy. The first one is the cash on cash in that year. Meaning, when I put in my $20,000 of premium, when does my cash value grow by that same $20,000 in premium? Okay, so look at year 2 cash values, non-guaranteed side, total net cash value. Year 2, it says $31,022. Do you see that there? $31,022. So from year 2 to year 3, my cash value grew from 31 to 50. That's a $19,500 increase in my cash value from year 2 to year 3. Would you agree? How do I get that number? Take 50,527, subtract 31,022. So that's a 19,000 and some change growth from year 2 to year 3. I'm almost breaking even, but I'm not there quite yet. But look at year 4. Year 4, my cash grew from 50,000 to 70,000 and some change. By year 4, I'm hitting my cash on cash. I put in 20,000 of premium and my cash value just grew by $20,200. I'm pulling out $200 more from this policy than what I even put into it in that year. And do you think that growth is taxable or tax-free? Just a reminder, it's tax-free growth. So that's the first break-even point that I look at, is when does my cash on cash growth exceed what I put into the policy that year? And you can play the game all day long. I mean, literally, look at year 25 when this individual is age 91. Year 25, they put in $5,000 of premium that year, and the cash grew from 407, or excuse me, the cash grew from 393 to 407. I'm going to take 407, subtract my 393. That's a $14,000 growth with a $5,000 net injection. What's that growth, or what's that rate of return that year? And this is just what's happening inside the policy. I'm not even talking about what this individual is doing outside of the policy with investments or purchases that they're making here with it. So that's my first break-even point. I look at the cash on cash in that year. The second break-even point that I look at is the accumulative cash. Okay, this is where a lot of people like to look. They're always going back to my cumulative cash, which is a good point. Okay, you have your investor mindset on, and you guys are really just looking at the numbers. How much have I put into this thing? When does my cash value equal that amount of dollars that I put into it? Here, it seems to be happening in the 10th year. Okay, so if you take 20,000, multiply it by 10, you've put in 20,000 every year over 10 years. That's $200,000 of cash that you've put into this policy. And year 10 cash values is $210,070. So you have $10,000 more than what you totally contributed to the policy, or cumulative net injection. Actually, it actually even happens in year 9. Year 9, you put in $180,000. Actually, year 7 or year 8, excuse me. Year 8, I put in 160. My cash value is 162.78. So real break even cumulatively is year 8. But then every year after that, year 9, I put in 180. My total is 184. Year 10, I put in 200. My total is 210, right? And you see how it continues to grow. By year 11, I put in $205,000 and my total cash is $221,000. Okay, so you guys can study these numbers and do whatever you want with it, right? What I'm saying is that you guys will start to get paralysis by analysis if you continue to go deep dive into these numbers, okay? Is the numbers important? Yes, it's important to have a good policy illustration, making sure I'm breaking even by these specific years. I always think that a good policy is cash on cash break even is by year 3 to 5, and my cumulative cash break even is anywhere from year 6 to year 10. That's a good policy illustration. But what if it doesn't happen? Hannah, what if I get table rated on my policy? What if I have some health concerns going on? That's okay, because it's all about the concept, y'all. And this was my biggest beef. And that's why when I was talking with this VP of an insurance company, Mr. M, I said, dude, I don't get it. These people want to go deep into these numbers, and I get it. I understand as society, because of the stock market, your brokerage account, your 401k account, y'all just want to look at the numbers, but you neglect the process of this concept. And you're not understanding that, hey, why did I even start this policy in the first place? I started this policy because I wanted to have control. I wanted to have liquidity, access to my capital. I wanted to get the government out of my hair. I want to pay the tax that I rightfully have to pay, right? I'm not a proponent of tax evasion, all right? I was about to go down another rabbit hole. We don't got to go there. But if I can legally follow what the wealthy are doing and legally minimize the taxes that I have to pay to the IRS, because no offense, IRS, you guys are kind of bullies, all right? I'm going to do so. And so inside of this account, it grows. It's still liquid. It's tax-free growth. The government's out of my hair. And I have total ultimate control and autonomy of what I'm doing with my money. Y'all ask yourselves, okay? A lot of people on this call right now, you guys are putting money into a 401k, an IRA, a qualified account, and you could probably be using that money right now. Do you have debts that you're paying on? Are you paying a mortgage? Are you paying a car loan? Do you have credit card bills? Do you have college and student tuition that you're paying? You guys could probably be using that money right now. But instead, what you guys are doing is you're taking your good dollars today, because reminder, is a dollar worth more today or is it worth more in the future? It's worth more today. And you're taking your good dollars today, you're paying it out to somebody else for them to control. And have you ever noticed that the only time you actually lose money is when you give up that control to somebody else? Just saying, think about it. And you're hoping and praying that in the future, you're going to have this money to live off of for those retirement years. But the definition of money is nothing more than just a means of exchange, right? That's all that money is. Money equals food. Food equals money. Money equals car. Car equals money. Money equals house. House equals money. That's all that money is. Money is nothing more than a means of exchange. But for some reason, as a society, they just programmed it to us that we need to hoard our money, act out of that scarcity mindset rather than the abundance mindset. And so y'all will go do things with money that you would never do with things that money buys. You would never go purchase yourself a car, a boat, a house, and then wait until you're 59 and a half 20 plus years into the future to drive the car or move into the house. That would be kind of stupid and kind of ridiculous, would it not? So why are you doing that with your money? Just think about it. But I know it's never been a normal conversation to talk about your money this way. It's just, hey, I'm going to go work, grind, go hoard my money, save my money over here, and then keep my fingers crossed. Hopefully this plan works out for me, and then the government's going to take care of me. How well is that working out for some of us folks up to this point? Have you been seeing a lot of those greeters at Walmart or at Sam's Club or at Costco? I even saw a gal not too long ago when I was going through, we have a new Zaxby's over here, by the way, in Daytona Beach. And I was at Zaxby's on Sunday after the beach day. and because I wanted some chicken. And the lady working the drive-thru, she was of retirement age. And I'm thinking to myself, are you here because you absolutely want to be here? You want to get out of the house? You want to go do something with your day? Or are you here at retirement age working this job because you have to, because of survival, because your retirement plan didn't work out how it should have been? I didn't ask the question, but I thought it to myself. So if you truly understand this concept, the numbers truly do not matter. Okay, it does not matter when it comes to this concept. But again, I know numbers, yeah, we're going to get into it, especially if you're a client of mine. Yes, we're going to talk about policy illustrations. I want you to understand this stuff, but I don't want y'all to continue to get this paralysis by analysis because we're going so deep into the numbers. I can't tell you how many times people say, Hannah, I want to see an illustration for $300 a month, $700 a month, $1,000 a month, $2,000 a month. Shut up. I'm not going to run all those illustrations for you. I'm just being for real. I'm not going to run all of them for you because I've been here, done that. I got 17,000 clients in every state of the country. I know how this game is played. I know how this stuff works, and I know how your mind thinks. I've been there. I've done that. And when y'all start to receive all these policy illustrations, you guys are going to start to get paralysis by analysis. So what I tell you is, hey, I'll send you an illustration. I'm going to send you $1,000 a month illustration. If you want to see what a $500 a month illustration looks like, cut all the numbers in half. Cut the cash value in half, cut the death benefit in half. That's what a $500 a month illustration is going to look like. You want to see what a $2,000 a month illustration looks like? Take your $1,000 a month and just double all the numbers. Double the cash value, double the death benefit. I mean, seriously, it's that stupid simple, y'all. But for some reason, maybe it's me, maybe I ain't explaining it correctly to y'all or appropriately to y'all, but you guys just don't believe me sometimes. You just got to see the numbers. But that's okay. If you've got to see the numbers, you're just not my client. We're not meant to be together. And that's the fun thing about this, right? Hey, to go back to like our last little topic on last week, not last week, it was the week prior, of things that I've learned in business. That's the fun thing about being a business owner, right? You can kind of choose who you want to work with. I don't want to work with somebody who they're calling my line and I'm like, ugh, this individual called me again. I really don't want to talk to them, right? Anyways, go off on a little tangent. So I wrote like this down on a little sticky note. I was like, do you get the concept? If you truly get the concept, the numbers do not matter, okay? Now, I'm going to, let's just talk briefly a little bit about the death benefit side. Because this is a question I was getting asked. This one gentleman keeps texting me, and I'm like, dude, just hop on a phone call with me. Why do you keep texting me? Let's just have a phone call. He's asking me about how the death benefit is made up, okay? So here's just like a quick little snippet. Because of all of these moving parts, of your base premium, of your paid up additions rider, there is death benefit tied to all of these moving parts: base premium, the paid up additions, and also if you have a term rider on your policy, there is going to be a death benefit coming from all of those moving parts. And so when you add up all of the moving parts, that's where it brings us to the total net death benefit that's on this policy. So that's why you see like you're going to see different things within your illustrations about the PUA death benefit, the term death benefit, and then the total net death benefit. So all y'all really need to understand is that total net death benefit, that is the total death benefit that's paid out at the time of your passing. Meaning like, hey, if I graduate tomorrow, AKA pass away tomorrow, year one, then that $64,480, that's what's going to get paid out to my beneficiaries. Okay. All right. I need to pull up some other screenshots here. So give me 1 second to open this one up. Okay, good. Before I get into my next little segment here, I'll look at my questions coming into the chat box, but just hold on. This one open. Let's remove this from Studio, and I need to open this file as well. Okay. Texter says, U.S. Bank made it convenient being open Sundays too. The death benefit column, I would like to understand better the guaranteed side and non-guaranteed side. Okay. No, this is a good question. I got you. Let's pull up this policy illustration because this will show it a little bit better. Yes, perfect. Okay, I'm making it full screen for a second. This is just another insurance company, okay? Policy illustration. This is starting on the left-hand side, guaranteed side, you have the age of the individual, age 41. Their contract premium is $12,500. You can see the net cash value column, okay? No additional math has to be done on this guaranteed side. And then you have death benefit. So look at the death benefit on the guaranteed side and look at the death benefit on the non-guaranteed side. Do you notice how on guaranteed side and non-guaranteed, the death benefit continues to increase each and every year until we get to year 11? Year 11, death benefit on guaranteed side is $256 and some change. Death benefit on my non-guaranteed side is $336 and some change. And do you notice how on the guaranteed side, the death benefit remains level, where on the non-guaranteed side, the death benefit increases each and every year? The difference here in what you're seeing is that it's the dividends that are being paid out. The dividends that are being paid out. Those dividends that we have in our policy, how it's designed, how I design my policies, is the dividends that we receive go back inside of our policy as more paid up addition premium. So when those dividends get paid to us, that dividend goes back inside of our policy as more paid up addition premium. Remember, guaranteed side is assuming no dividends get paid. So there's no more PUA premiums coming back in. And so that's why you see the death benefit continuing to be level, is because there's no extra paid up addition premium buying us more death benefit that's coming in. It's just strictly whatever's coming from that base premium. And the base premium is fixed in value. It cannot go up. It cannot go down. The base premium cannot go up, and the base death benefit cannot go up, cannot go down. So that's the differences that you see here. Now notice, but Hannah, on the guaranteed side, why does my death benefit from year 1 to year 10 continue to rise? Well, it's because you're paying out of pocket paid up addition premium. Okay, on the guaranteed side, I'm paying out of pocket paid up addition premium, and that's why that death benefit is moving up and up gradually as it goes. And just a little side note, there is a term rider here on this policy. So that's why we're seeing the death benefit drop slightly as your premium drops from year 10 to 11. The death benefit also drops slightly, and that's because of the term rider being added on. But that's the reason that you see it continuing to be level on the guaranteed side versus the non-guaranteed, because, okay, sorry, I'm about to go out of town today. My best girlfriend is texting me right now, so that's what all my dings are coming through from. Even though I have my do not disturb on, she's overriding the do not disturb. I love you, Julia. Because we got to go out of town. Actually, just, okay, ADD thought for a second, and something that I'm very happy about. It's been a lot this week, and I think that's where a little bit of my moodiness is coming from. Nanny and Papa, my grandparents, finally, they're coming to Florida. They're coming to Florida today. They're moving into assisted living. It's finally happening. I'm happy. I'm very happy. Like, I could literally cry. I'm so happy. It's a long time coming. And I'm like, oh, thank goodness. You guys need to be closer to us. You need the support, and we're here to support you. So come on down, Nanny and Papa. So that's That's going to be a lot of fun. I'm very happy and very excited about that. But yeah, it's been an emotional toll. You guys know that if you've ever taken care of your grandparents or elders, where they need the help, they need the care. And their time on this planet is just going out, and so I want them to be closer to us, and I can hang out with Danny and Papa, go do some stuff. So anyway, she's been texting me, so sorry for all the dings. Okay, so so to answer your question, CLG McCoy, I'm gonna call you McCoy, hopefully that's okay. That's why you see the differences in the death benefit on guaranteed versus non-guaranteed. It's because of those dividends and those paid up additions. That's the only reason why on non-guaranteed side, you continue to see your death benefit increase, or on the guaranteed side, it starts to remain level. Now, Dave chimed in for a second. He says, I work in elder care, and even when things are planned, it can be challenging. I know, my man. It's a lot. Thank you. Thank you for being here. Also, I want to know if you started to get into that RAL business yet. Are you connected with Isabel? Hopefully you are. And also, we're talking later on this month, okay? So good to always see you on this morning. I did want to get into the topic of IULs for a second, but I think I'm going to save that for next week, if you guys are okay with that, because I don't want to totally overload you. I've noticed that sometimes I can go so deep into my brain dump on y'all that things just don't click. So I don't think I want to go into the IUL conversation right now. I also kind of want to wait to talk about when you start to become your own banker, the numbers on these illustrations will become better and better than what you see here. And where this conversation comes from, if you go to Nelson's book in the equipment financing chapters, okay, the Black Book, Becoming Your Own Banker, he proves this to us. And he proves that if I say the one-liner that if you continue to be an honest banker, you pay yourself back with interest. Treat your money just how you treat the conventional bank's money. If you continue to be an honest banker, the values in these illustrations are going to be larger than what it's actually illustrated out right now. Why? It's because we're paying more paid up addition premium. And I have these two examples I was going to show you, but we're here at an hour, and I don't want to totally overload y'all's brains right now. But this is what we're going to be talking about next week, okay? So come and join me back next week, 9 a.m. Eastern time on Thursday. Let's talk about, and I'm going to prove to y'all that the more that you use this policy to buy the things that you're already going to buy in life, the larger these values will become. I'm going to prove that to you in an illustration. If you don't want to wait for me, go and read Nelson's book and read the equipment financing chapters. And then I'm also going to talk about IULs. Okay, let's get into that conversation because that's still a conversation that keeps popping up. And then I'm also going to share a family story about my second cousin and listening to the noise that's out there. So I think this is where I'm going to leave y'all at here today. Think for yourself and question, okay? Be open, hear what other people are saying and what others are talking about, but think for yourself and question. Sometimes you need to fire your friends and your family members because they could be the biggest ones that are holding you back from your truest potential. I'm going to share a family story next week about how that happened. I actually got two stories I could share. But go do your own due diligence, connect with like-minded individuals, and you got this, okay? I mean, seriously, I know it can be a little overwhelming like when you first get into this whole world, but don't overcomplicate this stuff. Keep it stupid simple. Go back to the sources, read Nelson's book. I can send you our book, Mapping Out the Millionaire Mystery. So just send me an email, hannah@themoneymultiplier.com. I'll send you that resource of Mapping Out the Millionaire Mystery if you guys are readers. go to my podcast show, the Money Multiplier Podcast. You can see a lot of content on this topic there, just everything money related. But until next week, I think I'm going to leave it here because, again, I don't want to overload y'all. Okay. Hopefully that's okay. Okay. Emails, stop it. Do not disturb. Going back on. But until then, okay, I am going to be away just for a little bit. We got some family stuff we're dealing with. Okay. So if I'm a little MIA on my emails, I apologize, but I will be answering. Okay. I also have my assistant here as backup. Shout out Matthew Fisher. Matthew, I just want to say I appreciate you. You're always very helpful to me. And I do really just appreciate the help that you have given me. So I'm very appreciative of my team. And until next week, my friends, do well, be good. Don't do anything that I wouldn't do. And we got some more fun stuff coming next week. All right. Mwah. See you then.